10-year note yields moved lower early in the session, trading all the way down to 420 before rallying back higher and closing higher on the day, up 2 basis points at 427. Now, early in the session, we got the ADP number, which came in stronger than expected. That was followed shortly after by GDP for third quarter, which came in slightly weaker than expected. Now, all eyes will be on tomorrow's inflation data, Friday's non-farm payroll, and then forward looking to next week when we have the U.S. elections on Tuesday and the November FOMC on Thursday. So still a lot ahead on the calendar, but 10-year note yields remain elevated, again closing up 2 basis points today at 427. Now, what does this mean for volatility? Well, check out that CVOL index over at cmegroup.com, and as yields remain elevated, volatility remains elevated as well. Volatility still sitting at year-to-date highs as the aforementioned events that lie ahead of the market and the possible aftermath, obviously with inflation, jobs, elections, and FOMC all in the next week and a half, keeping volatility elevated, and it continues to do so as yields remain elevated. Lastly, let's talk about what we do have tomorrow. Tomorrow is Thursday, which means we get our in-the-moment look at the job market via the claims number. We'll also get the challenger job cuts before that. We get the employment cost index, but the highlight number of the day will be the PCE data. That will be the Fed's preferred inflation gauge, followed up lastly by the Chicago Purchasing Managers Index. So midweek yields remain elevated, closing out today at 427, up 2 basis points ahead of tomorrow's challenger job cuts, jobless claims, employment cost index, and the PCE data.